This is Jessica Dunn. This is Chapter 2, Economic Development Finance. We're going to talk about the role of equity and debt. There are two different forms of investments. There is debt and there is equity. Debt is contractually obligated to be repaid. So a bank loan would be an example of debt. You have borrowed money from someone and you are contractually obligated to repay it. If you don't, there are legal repercussions. Equity, on the other hand, is an owner's investment in their business. Equity represents ownership. Equity is received in exchange for a financial or other contribution to the business. Equity investors receive dividends. Dividends are not contractual. These are payments from earnings that are not reinvested in the business. Equity returns are not fixed, so they may receive a dividend, but these dividends are not fixed and they are not contractual. Businesses are not obligated to make payments to the owners, and earnings are not limited if the business does well. Equity is represented through shares of stock. There are two types of stock. There is preferred stock and common stock. Common shareholders have both financial and governance rights. They have claims on dividends that are distributed, and they receive a right to vote in elections. So they can elect board members, they can vote to merge, they can vote to authorize new stock, or basically any major business decision. Equity holders have the right to have their voice heard. Preferred stockholders, they have a preferred claim to dividend payments. So preferred stockholders are higher up on the food chain than common stockholders. They are promised a dividend. These dividends are set at a fixed rate, so they are capped, and they're usually cumulative. And what I mean by that is that if a company has promised preferred shareholders a dividend and they aren't able to make that dividend, so they didn't make enough money to actually pay the dividend that they promised, then they have to make it up next year. And they keep having to make it up until it's paid. So if they missed it for 4 years, they would have to make up all 4 years of those dividend payments before they could pay the common shareholders anything. Preferred stock is usually acquired through venture capital, so it's not something that just anyone has. The most important issue in equity financing is determining the value of a company. So it's determining how much investors must pay to purchase a specific portion of the company, because remember, shares of stock represents a fractional ownership in the company. So if there are 2 million shares of stock outstanding and you own one share, that means you own 1/2,000,000th of that company. So how much do you pay for that 1/2,000,000th of the company? It's an art, not so much a science. It's based on guesstimations of what you think will happen in the future within the company, within their returns, and within the entire market as a whole. So what do you think interest rates, how will they fluctuate? So here's an example. A venture capitalist is interested in a company that's currently worth $5 million. They want to invest an additional $10 million in the company to help it grow and to reach new markets. So now the company would be worth a total of $15 million. So by the books, the venture capitalist would now own 2/3 of that company. However, it doesn't always work that way. That's why it's as much of an art as a science, because it depends on the skill of the negotiator. So how well can the venture capitalist bargain, or how well can the company bargain? Additionally, it has to do with the connections that the venture capitalist would be able to have with the market. So the ownership percentages are not fixed. There are investment terms that exist to protect financial and governance rights. So preferred shareholders are often allowed to elect one member of the board alone. So there's one board member that's dedicated to the interest of the preferred shareholders. There are often anti-dilution rights, which would restrict a company from issuing new stock and selling it to specific individuals who maybe want things to go a specific way. They would first have to offer the new shares of stock to existing shareholders so that way they can maintain their proportionate ownership. So it would protect an investor in the case of stock splits or in case new shares of stock were issued. Another thing that could be within the contractual terms of a company is non-equal voting rights. So there may be multiple classes of stock, and each of those classes of stock may have different voting rights. So, for example, a company may have Class A and Class B shares. Class A shares receive 10 votes per share of stock, while Class B shares receive 1 vote per share of stock. And these would be set up in the bylaws and the charter of the company. Usually the individuals who have the greater voting rights are the founders of the company or pre-IPO investors. So what are the advantages of equity? First, there's no fixed payment required. So with a debt contract, when you borrow money from a bank, you're contractually obligated to repay that money in fixed proportions over a specified period of time. With equity, that's not true. There's no fixed payment burden, and dividends are hoped for but not contractually promised. So if a company is having financial hardships, dividends don't have to be paid. Second, it is a long-term source of funding. So it's concerned with building company value as opposed to debt. Debt has a fixed maturity date. So at some point, it will be repaid. Number 3, assets are not used as collateral. So whenever you borrow money in the form of debt from a bank, they're going to want you to put up some of those assets as collateral. That simply means that you can't borrow additional money against those assets in the future. So if you weren't able to repay your debt, the bank would be able to seize those assets and hopefully sell them for at least as much as you owed. But with equity, the firm's assets are available for other financing needs. So the assets have no claim on them. So equity investors could invest in the company, and then they could also borrow money against those assets. So it's kind of like double dipping. Equity investors do not claim a firm's assets collateral. The assets that a firm purchases with equity can be used to raise debt capital. And fourth, there are fewer restrictions. Debt holders often impose financial covenants on a company. So they may say, they may tell you exactly how those loan proceeds may be used. So they're going to have a heavy hand on your company. They may say, because you borrowed money from me, you're not allowed to borrow money from anyone else. Or your financial ratios have to be within a certain range. Or you can't take specific actions because it might endanger your repayment of their money. With the equity, there usually isn't restrictions such as that. Disadvantages of equity. Number 1, it dilutes ownership and control. So existing owners have to give up ownership, and they have to give up some control as well, because now there will be board members who are elected by the shareholders, the owners of the company, and these board members will now be able to make business decisions and will be able to appoint managers, even to people that the founding family may not like. Second, limited availability. Many sources of debt financing exist. Equity investors, however, are few and far between, because you would have to find someone who believes in you enough to give you their personal life savings. Few firms fit the investment criteria of venture capitalists or are ready for an IPO. So usually, whenever a company is just starting out, the existing owners, the founders, are going to exhaust their personal resources. Once they've exhausted their personal resources, their first go-to would be their friends and their family. Once they've exhausted that, then they may be ready for a venture capitalist. It depends. And third, it's an expensive form of capital. Equity is expensive. Investors expect high returns for the large risk associated with investing. They are going to require a large share of stock for a modest infusion of capital. So most of you, I'm sure, have seen Shark Tank. Shark Tank, this is an example. They give you a small amount of money and they want a huge amount of your company. So now let's move to debt. Debt is a contract between a lender and a borrower. Funds are provided to the borrower and repaid to the lender. Borrowers must repay funds according to a defined interest rate and principal repayment schedule. It's different from equity because there are specific terms for how the investor must be repaid. Debt holders' return is set by contractual terms. Equity, on the other hand, their return depends upon future earnings and the value of the company. Debt is a fixed obligation that must be repaid regardless of earnings. If a firm fails to make their debt repayments, the lenders have the right to sell specific firm assets to obtain repayment. Debt also differs from equity because debt does not confer any governance rights to the debt holders. So equity holders get a vote. They get a say-so on how the company is managed. Debt holders cannot exercise control over the firm's governance and management. They're not receiving a vote. They can, however, impose covenants on the company. They can make restrictions. They can require that companies take specific actions, but these requirements would have to be listed in the debt contract. So examples of restrictions or covenants would be that the company is not allowed to pay dividends, or that they cannot sell certain assets, or that they cannot increase managerial salaries, or that they must maintain life insurance on employees. Debt contracts address financing terms. So they're going to address the size and the timing of payments and the lender's right to collateral. So within a debt contract, it's going to specify the principal. The principal is the amount of funds borrowed. It will specify the interest rate. This is the price that is charged for using someone else's money. It's calculated with an annual percentage rate. Loan terms and maturities. This is the amount of time that a company would have to repay a loan and the amortization period. So this is the amount of time the loan is being amortized. So there are different examples of this. A loan could be fully amortized, and this means that the maturity and amortization period are the same. So there would be no balloon payment. So whenever you hit your maturity date, your loan is paid off. A partially amortized loan may mean that you are repaying a portion of the principal every month and the full interest every month. And so whenever your loan matures, you're going to also owe a lump sum at that point, a balloon payment. An interest-only loan means that you're paying interest only. So at the end of the loan's life, you still owe the entire principal of that loan. So generally, whenever we're talking about individuals and you purchasing a house or purchasing a car, your loan is fully amortized. So that simply means that whenever your loan expires, it is also paid off. That's not always the case. I have on Canvas an example of a mortgage that I have that is partially amortized. So it's amortized over 15 years, but the loan matures in 5. So that means that at the end of the 5th year, I owe a sizable balloon payment. Now, in reality, the way that works is that the bank, at the 5-year point, I do technically owe them a huge lump sum, but we will probably refinance at that point for the remainder. It's really there to protect the bank. So if I'm not a good risk at that point, they have the option to say, no, we do not want to continue to have you as a customer. You have not repaid your debt as you should, and so you need to find financing elsewhere. And then there's interest-only loans where you're paying just the interest. So having a balloon payment at the end of the life of your loan protects the bank. It also, whenever you partially amortize a loan, it's better than an interest-only loan because you are repaying some of the principal every month, so it makes a smaller balloon payment upon maturity. The amortization period is going to influence the monthly loan payment and the principal balance over time. Loan collateral. So when you borrow money when you borrow money for your business, the bank is going to require some form of collateral. They're going to recognize specific assets that you hold as the collateral. If the borrower does not repay the loan amount, the lender will seize the asset. So generally with your car or with your home, the car or the home would be the collateral. If you didn't repay, the bank would take those assets. The ability to receive assets depends upon the lender's seniority. So if you only have one loan against your assets and you don't repay, that one lender has access to your assets. If, however, you have multiple lenders, the most senior lender, as it would be specified in your contract, the most senior lender would receive assets first. Once those assets were sold, that senior lender